Welcome back to The Explainer, everyone. If you've ever, worked in accounting or just had to manage a budget, you know that keeping the books perfectly balanced, it's honestly a delicate art. But what happens when reality just throws a massive wrench into your perfectly organized ledger? Okay, let's dive into this. Today, we're unpacking a highly stressful yet incredibly common accounting scenario, the absolutely dreaded missed invoice.
The source material sets the scene perfectly here. Quote, "Oh, an accountant realizes that a cost is not recorded in the closing of the year because the supplier invoiced it in the subsequent month, in January." I mean, just imagine that sheer moment of panic. You're closing out the year, wrapping up the financials, everything looks great, and then bam! Suddenly you realize a major cost belongs to the year you are desperately trying to close, but the supplier didn't actually send the invoice until late January. Your heart literally drops.
So what exactly happens when a supplier invoices you late? This is the central dilemma of our explainer today. How do you handle this looming year-end audit disaster without completely wrecking your financial records? You can't just pretend the expense didn't happen, right? And you certainly can't just record it in the wrong year. Doing that completely distorts your company's profitability, throws off your entire forecasting model, and, well, it gives a totally false picture of your financial health to anyone looking at those books.
To understand how to fix this whole mess, we first need to understand how we even got here. There are two very specific, super common reasons for this headache. First, the vendor simply submits the invoice late. You bought the goods or maybe used the services in December, but they just drag their feet and don't bill you until January. The second reason? Pure human error. You simply missed recording the invoice and are only realizing it now at the time of an audit. Think about it. An invoice gets buried in an inbox during the chaotic holiday rush, and nobody notices until the auditors are literally breathing down your neck. Either way, you're stuck with an expense that belongs to a year that's already closing.
This brings us to a golden rule of accounting. The timing of accounting the cost is very important. You simply cannot mix and match your years. If a cost was incurred in one year, it absolutely must be recorded in that year. Bad timing ruins the accuracy of the books, plain and simple. And that strict rule is exactly what sets up the need for a specific accounting tool known as a provision. Think of a provision as, well, a financial placeholder. It's a way to officially recognize that you owe money for something right now, even if the actual physical piece of paper billing you hasn't arrived yet.
Let's ground this in a chronological case study to make it super clear. Imagine it's December 31st, 2025. This is the year of accrual. This is the exact period when the expense actually happened, but unfortunately, it got missed. Now, fast forward a bit, we hit January 15th, 2026. This is the subsequent month, the moment the vendor finally gets around to sending over the actual invoice. So we have a gap in time between when the expense occurred and when the bill actually arrived. We desperately need to bridge this gap to keep our 2025 books accurate.
Step 1. The first provision entry. To solve our December problem, we go back to the date the expense got missed, December 31st, 2025. We debit the expenses account for, let's say, $1,000. Then, we credit the provision of account, which sits in our current liabilities, for that same $1,000. Now, what's really interesting about this slide is how it solves our problem. By doing this, we successfully lock in that $1,000 expense in the correct year of accrual. Imagine the relief. You've officially marked down the cost exactly where it belongs, fully protecting the integrity of your 2025 ledger just before the books close.
Steps 2 and 3. Reversing and recording. Now it's January 15th, 2026, the subsequent month, and that actual piece of paper, the real invoice, finally lands on your desk. Because of this, we need to pass a new journal entry that does the exact opposite of what we did back in December. We debit the provision for expenses for $1,000, and we credit the expense account for $1,000. Why do we do this? Well, because we have to clear out that temporary placeholder we created. If we don't reverse it, we run a huge risk of double counting the expense when we record the real invoice. And that would be just as disastrous for the budget.
Now that the slate is completely clean for January, you record the actual invoice received by the supplier, normally on that same day, January 15th. Debit the expenses for $1,000 and credit the vendor account for $1,000. Boom! You've successfully navigated the standard three-step process. You created a provision in the old year, reversed it in the new year to clear the way, and then recorded the actual invoice as if absolutely nothing ever went wrong.
The direct shortcut.
Okay, so the three-step process we just walked through is the classic textbook way to handle a missed invoice. But if you want a shortcut to build an even more efficient workflow, there actually is an alternative.
Instead of passing that second entry to exactly reverse the provision and then recording the actual invoice, you can entirely avoid the reversal entry altogether. In this shortcut, you simply record the vendor invoice by directly debiting the provision for expense that you set up back in December. It achieves the exact same balance. It skips a whole step and leaves you with a lot less paperwork, which is always a win.
So, the crucial point is that whether you take the scenic route or the shortcut, you achieve two vital things here. First, you have successfully expensed the cost in the actual year it occurred, 2025. Second, you have accurately recorded the vendor liability as per the actual invoice date in 2026. Your books are now perfectly balanced. And why does this matter so much? Because perfectly balanced books are literally the foundation of a healthy business. It means your company valuation is accurate, your budget allocations for the next year are based on reality, and those auditors, they're completely happy when they review your clean, organized financial history. Which leaves us with one final, super important question to ask ourselves as we wrap up today's analysis. Look at your own ledgers right now and ask, are your vendor liabilities recorded in the actual year? If they aren't, well, you now have the exact blueprint to use provisions and fix that timing gap before the auditors come knocking. You don't have to panic anymore when a vendor sends a late bill. Hope this explainer helped you out. Cheers!